What do Fed enforcement actions really mean for your money? And how should investors read headlines about former bank employees facing penalties? Here's the context. The Federal Reserve announced actions involving 2 former staff members at community banks. The Fed didn't detail the terms, but reminded markets that conduct oversight is a core part of its job. This is not about rate cuts or hikes. It's about standards, accountability, and confidence in the banking system. Think of enforcement actions as the regulator's toolkit when conduct crosses lines. If supervisors find violations of banking laws, unsafe practices, or breaches of duty, they can step in. For individuals, that can mean bans from the industry, civil money penalties, or mandated fixes. The goal is simple: protect depositors, safeguard lending standards, and keep the plumbing of finance running smoothly. There's a key nuance here. These actions target former employees, not the banks themselves. That distinction signals personal accountability without implying the institution is unsound. For a bank, resolving personnel issues can actually reduce operational and reputational risk. It can close a chapter, strengthen controls, and let management focus on lending and customers. This sits within the Fed's broader supervisory framework. Supervision runs alongside, but separate from, monetary policy. Rate decisions move funding costs and valuations. Supervision makes sure banks manage credit, operational, and conduct risks. Examiners look at capital and liquidity, risk management, compliance, and governance. Publicly disclosing finalized actions adds transparency and deters misconduct. Why should investors care? Accountability at the individual level reinforces ethical expectations, where people handle customer funds and data. Targeted remedies can protect consumers and keep lending prudent. Clear follow-through can reduce uncertainty about bank risk, which matters for credit spreads, funding access, and ultimately, earnings stability. So what's the practical takeaway when you see news like this? Separate the who from the what. If actions involve individuals and not the institution, it often points to control gaps being addressed rather than systemic weakness. Watch how the bank communicates about remediation, compliance upgrades, and board oversight. Track regulatory disclosures over time to see whether issues recur or resolve. And remember that strong supervision is part of the backbone that supports market confidence, especially in a cycle where investors are already watching growth, inflation, and rates. Stay informed, read disclosures closely, and assess whether governance trends are improving, stable, or deteriorating. That lens can help you price risk more accurately across bank stocks and credit. Read the full article at finlitica.com.